Good morning, everybody. Friends, I am thankful to this pioneering institution for inviting me to make a presentation in this webinar. Myself is Dr. Gopalkrishna Bhat, former principal of this prestigious institution, Dr. Baliga College of Commerce and PG Studies in Commerce, MCom. With this webinar, I feel happy to make a presentation of my views on the very important topic, bank mergers. Bank mergers, a revolutionary change in the history of banking sector in India, that too in the public sector banks. My topic is recent bank mergers, a synergy for growth of Indian economy. Friends, you know that synergy is a 1 plus 1 equal to 3 concept. When the interaction of 2 or more organizations to produce a combined effect greater than the sum of their separate effects, that is synergy. You know that Prime Minister Narendra Modi announced that the government of India's long-term vision is to reach 5 trillion US economy. It is definitely a claim most required, but not a tall claim. It is achievable if all the sectors of economy is streamlined. In view of this 5 trillion economy dream, many rational measures in the areas of economic sector, social and educational sectors have been started. One of such measure is bank merger. As regards the recent bank mergers are concerned, the merger wave started with the integration of 5 SBI associate banks with SBI with effect from 1st April 2017. So that State Bank of Mysore, State Bank of Hyderabad, State Bank of Travancore, all have subsumed in State Bank of India. place in the financial year 2019-20. That is by reducing total public sector banks from 27 to 12. As a result, Oriental Bank of Commerce and United Bank of India merged with Punjab National Bank, Syndicate Bank absorbed by Canara Bank, Allahabad Bank merged in Indian Bank, Corporation Bank and Andhra Bank amalgamated with Union Bank, Vijaya Bank and Dena Bank merged in Bank of Baroda. What a revolutionary change took place in the banking sector. The overall goal is to boost the economy. Synergical effect is the requirement. These public sector banks, which control 2/3 of India's banking in terms of advances and deposits, are meant to create a stepping stone to achieve the government's target of 5 trillion economy. Of course, unfortunately, the outbreak of COVID-19 may create some difficulties and it may delay the things to happen. It is a claim of the government the economy should be triggered. Banking sector reformation is one of the requirement for achieving 5 trillion economy, as I already told. Mergers will make a drastic change in many areas of banking, particularly operational area, improvement of capital base, more and more specialization, right sizing and downsizing of staff, installation of sophisticated technology, reduction in the cost of operation, and consequently lower interest rate advances, improving the competitive strength, strong national presence, product diversification, and so on. Improvement in liquidity, which is more essential in banking sector. Make in India and make for world is possible only if rapid industrialization, either by expansion and diversification of existing industries with modern technology, or more and more startups in each sector of the economy. Bank finance is the basic requirement for all these purposes. Banks having a large capital base only can make lending up to the requirement of the industry. For example, you take SBI, after the merger of 5 associated banks with FAI, its turnover has been increased to about rupees 52.1 lakh crores from earlier rupees 17 lakh crores before merger. And its market share will be not less than 22.5%. Is it not a strong indication of increase in its capital base? Now the SBI is capable of lending any amount of money to any firm, not only in India but also to overseas firms, that too with a reduced cost. Another example I give you, merger of Syndicate Bank in Canara Bank. The total business of amalgamated bank is expected to be rupees 15.20 lakh crores with a market share of 6.6%. The merger of Oriental Bank of Commerce and United Bank in PNB. The merger places PNB in second place after SBI with a total business of 17.04 lakhs crores with a market share of 7.7%. The latest statistics comes from Bank of Baroda. Its total business stood at INR 16.3 lakhs crores as on 31 March 2020, up by 4.4%. These are all the strong evidences relating to increased capital base of the banks. Is it not a synergical effect which can boost the economy? The mission of the government of India is to reach $5 trillion economy with the philosophy of Atmanirbhar Bharat, make in India and make for the world, will remain in paper unless the banking sector is vibrant enough to respond to the credit needs of trade, commerce and industry as well as agriculture. Also, there is a need for concrete effort to boost the investments and savings as well as consumption. It is possible only when the banks have large capital base. Merger is the answer under present situation of India to improve the capital base. Merged banks can realize large scale operation benefit, cost efficiency requires scale economy always. Banks must operate with some minimum scale. Take for example the 6 merged banks, SBI, PNB, Bank of Baroda, Canara Bank, Union Bank and Indian Bank together will hold a total market share of 53.6% with a huge turnover of rupees 124 lakh crores. This will place the merged bank as one of the global competitor. SBI is already a lender to the overseas firms, mainly of Indian origin. The merger of 12 banks apart from the consolidation of SBI created a stronger established organizations with enhanced capacity to increase credit. Each one of the merged bank can meet the capital needs of the industry. The merger effect can be seen now. Already almost all types of lending cost, rate of interest is reduced. Merger is one of the reason for that. This is my viewpoint. The low cost lending is one of the prime financial synergy, we can say. Merger resulted in increase in CASA ratio. Increase in CASA ratio is one of the indicator of financial health of the bank. A higher CASA indicates a lower cost of funds. What is CASA? It is the ratio of current account and savings bank deposit to total deposits. Banks are not giving interest on current deposits. They pay very small interest at a rate of 1% to 3% on SB deposits. So increase in sales ratio means availability of more and more low cost funds for lending. CASA ratio of SBI is increased to 48%. PNB 41%, Canara Bank 30%, CASA deposit to total deposits of Bank of Baroda improved to 39.07% as on March 31, 2020 from 37.26%. This means after merger, PNB can lend about 4 lakhs crores out of CASB deposits only. Canara Bank can lend 2.4 lakhs crores out of CASB deposit. So with the increase in CASA deposits, merged bank can reach out to the borrower at a low cost. In the national and international money market, so that Indian industry, trade and commerce, agriculture can try for cost efficiency. From human side also cost competitiveness can be achieved. Say after merger, pooling of human resources possible. Pooling of human resources makes available large scale expertise in every sphere of banking operation. Thus, the scale of inefficiency, which is more in case of small banks before merger, will be minimized, particularly in cities. Take for example, each bank earlier had number of branches. Now after merger, what happened? Some of these branches can be closed or shifted on rational basis without any problem to customers. That has happened. For example, SBI has closed or merged about 2,550 branches. Overall, 3,400 branches are closed or merged by public sector banks after merger without any retrenchment. Of course, voluntary retirement option is given. There was no retrenchment and no inconvenience to customers. In fact, more financial inclusion is achieved. The rationalization of branch network by closing, merging and relocating the branches to maximize the efficiency helped SBI and other merged banks to optimize the operation and improve the profitability. Multiple posts of CMD, DM, AGM, zonal managers, etc. will be abolished. These are all human side energy. This human side synergy helps for considerable savings in the cost. You know that NPA is one of the biggest problem ever since the banking sector facing in India. Let us consider some viewpoints with regard to NPA and risk management after merger. Merger will result in better NPA and risk management. This is my statement. NPA in public sector banks, as I already told you, is one of the deadly problem of the country. Many studies have revealed that merger is not a solution for NPA management to reduce or eliminate NPA. One study conducted recently clearly indicated that post-merger NPA is more and increasing compared to pre-merger NPA. I am not disputing with that study, but at the same time, please note that BOB reported gross NPA ratio fell to 9.40% as on March 31st, 2020 against 10.43% as on March 31, 2019 pre-merger period. As regards the NPA is concerned, NPA is the outcome of bad loans since many years. Political interference, absence of transparency in banking, poor and ineffective procedure in KYC, know your customer, and poor due diligence before lending, lack of specialization, economic slowdown, etc. are major reasons for NPA over the years. Now the problem of NPA is further aggravating because of the outbreak of the COVID-19, which resulted in the negative GDP growth. So streamlining NPA is a challenge always. Merger can help in this regard. For instance, you take the case of the SBI. After merger, SBI has introduced centralized loan processing system. Even technology also very widely they have started using. YONO, YONO, and it is an app. Now those who need advances can apply through this app only. His application, everything will be processed by using technology, so that ineffective KYC, transparency problem, interferences by vested interests, politicians can be considerably reduced when the technology is used, and as per the technology outcome if the lending is undertaken, so that bad loans can be considerably reduced. SBI started it. When I have told they have introduced centralized loan processing system. There is a separate wing for mobilization of the deposit, recovery of the loans, KYC. So that acute specialization is introduced in its operation, so that the manager can now devote much time in day-to-day operations. On the one side, because of this use of technology, day-to-day operational efficiency increases. On the other hand, bad loans decreases. This helped to reduce the bad loans considerably. Small banks are not able to introduce this minute specialization, high level technology in its operational span. Only merger can help because of this size. Pre-merger net NPA ratio was PNB 6.55%, Oriental Bank of Commerce 5.93%, and Union Bank of India 8.67%. Net NPA after merger of these three banks expected to be 6.61%. Similarly, pre-merger net NPA was Canara Bank 5.37%, Syndicate Bank 6.16%, post-merger net NPA is expected to be 5.62%. Considerable decrease can be noticed. These figures are really encouraging. Chances of survival of underperforming banks increases. Hence, customer trust remains intact, which is vital for the growth of any banking sector. Sustained growth can be ensured. The NPA risk factor also can be handled more effectively in the post-merger period by increasing the PCR ratio, because PCR, provision coverage ratio, can be improved. It is one of the financial ratio indicating the financial health of the banks. You know that banks set aside a portion of their profit as a provision against bad loans, so that the NPA can be handled more effectively with the increase in PCR. Ideally, PCR must be above 70%. More the PCR means asset quality issues have been taken care of and bank is not vulnerable due to NPA. Bank as a custodian of the depositors can function as such in a real sense. For example, as on June 2020, the PCR of SBI stood at 86.32%, much higher than the minimum requirement. Bank of Baroda, excluding two merged bank, PCR was 63.76%, but including two merged bank, Vijaya Bank and Dena Bank, it is 77.77%. It is really synergical benefit. It is encouraging. This shows that the banks, without the support of central government, can mitigate the adverse effects of the NPA, and the liquidity problem can be solved considerably. CRAR, capital to risk weighted asset ratio, is measurement of banks' available capital to risk-weighted credit exposures. CRAR is used to protect depositors and promote the stability and efficiency of financial system. As per RBI guidelines, PSBs are required to maintain a CRAR of minimum 12%. The post-merger scenario shows considerable improvement. For instance, CRAR of SBI was 12.60%. Now it has been increased to 13.06%. CRAR of BOB has been increased to 13.30% as on 31/3/2020. This is an indication of more safety of the deposits in the post-merger period. This will further improve the confidence of general public, so that more funds will flow to merged banks, so its capital base will be further increased. Another ratio, take CET, Common Equity Tier 1 ratio. It is a capital measure as a precautionary means to protect the economy from a financial crisis. Banks' liquidity and ability to survive can be tested using CET1 ratio. The minimum must be 4.5%. SBI has increased it to 9.77%, BOB to 9.44%, PNB expected to increase it to 7.46% from earlier 6.21%. These are all the examples. Post-merger drivers of profitability synergy. Merger leads to increase in profitability because strong national presence, reduction in cost of operation, improved competitive strength, strong capital base, better NPA and risk management, introduction of technology, specialization using human expertise, diversification by introducing more and more products, and so on. For instance, the operating profit margin of SBI jumped from rupees 272.13 per share as on 31/3/2019 to rupees 288.33 per share as on 31/3/2020. Of course, all merged banks have not posted good profit in the post-merger period, but in the long run, as they are capable of controlling NPA, cost efficiency, operational efficiency, as I told you about the drivers of profitability synergy, definitely all merged banks will be in the windfall profit status. Human resource synergy is another area. That one should look into. Human expertise spread over different banks, now pooled and available for practicing more and more specialization. Right sizing opportunity is another advantage. As regards pay scale, etc., even before merger, among the PSUs there were no much difference. Differences were there in the areas of perquisites, promotions, Now comparatively the best perquisite policy and promotion policy will be retained. For example, you take one instance. In SBM, medical benefit was offered, but it was a lump sum amount per annum. In SBI, it was bill to bill reimbursement and also facility of panel doctors for medical treatment to the family also. It is a better perquisite policy. Now it is available to all employees, including the employees merged. In SBI, promotion is automatic. Usually promotion will be given after completion of the certain number of years service. In SBM, there was no such policy. Now it is a better policy from the human side. It will be retained. So, as I told you, even the branches are relocated, merged or closed, no retrenchment. So, the best person can be placed in the position for which he is best suited. That is the advantage of pooling of human expertise. This is the human synergy. Definitely it leads to the operational efficiency and transparency. So, bank mergers also can help in reaping diversification synergy. Larger the size of the bank, opportunity for diversification is more. The bank can offer more and more variety of products and services. Merged banks have widened their product coverage. So, merger has helped in integrated growth of banking sector. ICICI, HDFC are the examples who achieved success by diversification, that is offering more and more products. Now merged bank can practice such a diversification. So what I want to say to conclude is that bank merger has already offered or offers capital base improvement synergy, more profitability synergy, operational synergy, lower cost synergy, human synergy, diversification synergy. What more is required for the growth of the banking sector, consequently for the growth of the economy? So, friends, sooner or later, Indian banks can be seen in the global map of banks as one of the competitor in the world of money market. The core assumption is that merger yields synergy for the growth. Growth of the banking sector is nothing but the growth of the Indian economy. Friends, you can use the chat button or any other mode. If you have any questions, I will post the viewpoints regarding your questions to your required address. I thank the principal of this prestigious institution, Dr. S.V. Shenvi, the organizer, Dr. S. D. Bulla, Srimati Sushma Kamath, who helped for me for recording, etc. And above all the viewers of this webinar presentation. Thank you all. Thank you once again.